Hi, my name is Adrian Simmons, and I'm the Chief Creative Designer here at Element CPA, where we help entrepreneurs to design their business and their finances. Obviously, those designs right now are needed to take account of the coronavirus fallout. For some, it's being felt very acutely right now. For some, not, but maybe later. And so what I'd like to cover in this video, very briefly, is an overview of what's in the CARES Act for the four main provisions providing relief to small businesses. There's actually a lot more detail in that act. I do want to let you know on our blog we have a post covering it. I encourage you to take a look at that. But I'm going to really hone in on the four big provisions which create a decision for business owners about what they're going to do to either avail themselves of that relief or to come up with some different plans. So quick note, I'm not going to focus here heavily on the math side. We can get close enough to the numbers we need to make decisions without the math. There's actually a lot of debate right now on how to do the math, so just to make you aware of that. So let's go ahead and jump in and get started. So two pre-notes just to be aware of as we get started. One, each business is going to have a different answer on what the right move is for them. There's different options that are available, and depending on your business scenario, that's going to drive which one of these that you may or may not want to take advantage of. So it's not a matter of do this or do that. It's a matter of figuring out your business, your situation, and matching that properly to your strategy. Which sort of ties to my second note. Don't let the tail wag the dog. You're the one running your business. You sort of know what stands, what that outlook is. Don't let the government's program dictate or frame the decision for you. You want to know what it is and weave that into an existing plan that you have. In this video, I'll provide some resources to things that we've put together that can help step you through developing your coronavirus plan. We're also putting together a video for that as well as some other resources. So I encourage you, before you make any final decisions, to think through the overall picture for your business and where you stand, then see how these programs might integrate into that. So with those notes as a sort of a frame, let's take a look into our first step here. So in the CARES Act, there really are four main options available to small business owners for relief that are available to you. The first one, which is getting a lot of press right now, the Payroll Protection Program. We'll take a look at that. The second one, a little less known about, called the Employee Retention Tax Credit. We're going to take a look at that. The third one, enhanced or expanded unemployment benefits. We'll take a look at that. And lastly, more favorable economic injury disaster loans. So we'll take a look at that. And so these are really the four big pieces that you may have to make a decision on whether or not you're going to move on one or the other of them as you steer the future direction of your business. Let's break those down a little bit more, and then we can start to sort of compare and contrast to see what might work for you. First, the Payroll Protection Program. To be eligible for this program, you need to be a small business, you need to be self-employed or independent contractor. And a lot of efforts have been made in the law to include self-employed folks, independent contractors, so that's important to know. To be eligible, you also have to self-certify that the existing economic uncertainty causes you to need this loan to be able to weather it. All right, so it's actually a very relaxed standard. It's not a high bar. You don't have to demonstrate economic injury. You don't have to prove things out, or really, you just have to say, hey, there's enough economic uncertainty. Basically, you're nervous about where things are, and this help is going to help you get through that. The amount of the Payroll Protection Program is 2.5 times your monthly payroll. So roughly speaking, you're going to look at your payroll, whatever it is on average each month. You're going to take that and multiply by 2.5. That's the amount of money that you can get through this program. Again, as I mentioned before, there's a lot of haggling going on exactly what monthly payroll is. Leave that to the accountants, the Congress, the bankers, etc., to hash that through. But that's the gist of the idea. For those who are self-employed or independent contractors, again, guidance is still being developed, but the gist of the idea is to look at what your income was from the prior year, possibly from your tax return, try to average that out and figure out what 2.5 months worth of income is, and that's what you would get under this program. As I note here, it is a forgivable loan, so technically it's a loan. The idea is it's going to cover payroll, rent, utilities, and possibly other costs. But if it's used for those costs, it's forgivable tax-free, and that's important as well. A lot of times loans, if they're forgiven, generate taxable income. This would not. But it is critical that it's used for the intended expenses within the 8-week period from which it's granted. And at least 75% or more needs to go to payroll. The point of this program is to give give businesses money to pay people, and that's what they want it to go to. If you don't use it to the intended uses, it's not forgiven, it's just a loan. It'll remain on the books. 2 years, 1% are the terms that are being out there, which still is nice and favorable, but obviously having it forgiven is even more favorable. A little bit of the interplay of how some of these provisions work or don't work with each other. If you're going to do a payroll protection program and cover payroll costs for 2.5 months or 2 months, you can't also claim the employee retention credit, which we're going to look at in just a second. The idea is you either pay your employees and have the government support you in that process through the tax credit for retaining employees, or you get the money straight from the government to pay the employees, but you can't claim both of them at the same time. Second thing to know how this interplays with other provisions, you can't cover the same cost of the economic injury disaster loan. So if you get a disaster loan, and again, we're going to take a look at that in just a second, you can't also get the payroll protection costs for the same costs, a payroll protection program for the same costs. You can have both, but you can't use them to pay the same cost. They need to pay different costs. All right, hopefully that makes sense. Second of the main 4 provisions, the employee retention tax credit. To be eligible for this, your operations have to be fully or partially suspended, or your gross receipts have to have dipped 50% compared to the same quarter last year. So a slightly higher bar to be able to demonstrate that you meet the criteria to claim this credit. The credit itself is 50% of the wages you pay your employees on the first $10,000 per employee. So it's not the full amount of payroll. Basically, the government's going 50-50 with you on the payroll, and then they're going to credit that back to you out of payroll taxes that you would have sent. So file with your payroll provider, etc. Normally you have to send in payroll taxes. Basically, the government's going to give you a credit, and a refundable credit even, to sort of pay that amount. So a little different mechanism. As far as the interplay with some of the other provisions, if you get a payroll protection loan, you can't also claim the employee retention tax credit. It's an either or between these 2 provisions. We're going to look at a little bit later, there's something called emergency sick and emergency family medical leave. You can't double count the same wages as sick pay, emergency sick pay that the government's going to finance, and also the employee retention credit. Okay? That part will make a little bit more sense as you look at the other pieces, but just know that they can't pay the same wage. Third main provision, expanded unemployment benefits. And this has been expanded to self-employed and independent contractors. Again, often those folks are not covered under unemployment, and they are really being sought to be captured and supported in this process. It also covers what's called short-time compensation arrangements. So traditionally under unemployment, if somebody maybe is working as a reduced wage, they're still working, therefore they're not unemployed, therefore they're not eligible for unemployment benefits. The provisions the federal government introduced are intended to say, hey, even if somebody's working at a reduced amount, if it's a big enough dip, they're still going to be eligible for unemployment benefits. So that's a critical piece of information there. This has gotten more press about how this works. Basically, it's the state benefits that you would otherwise get. A state may be somewhere around 40 to 50% of a typical wage, and the federal government is going to tax $600 on top of that every week. So that's a decent benefit. Again, the state usually has their normal window of time to provide those benefits. The federal government is going to add on 13 weeks to that. As far as how this interplays with some of the other provisions, basically, if you're paying somebody under the payroll protection program or you're paying them under the employee retention tax credit, they're not unemployed and therefore they can't claim both again for the same wages. So that one's pretty straightforward. The fourth and final main provision of the larger items is the economic injury disaster loans. These are types of loans that have existed before, but they've been really expanded and they've been made very favorable in light of what's going on right now. So eligibility, small businesses, sole proprietors, independent contractors, nonprofits that are suffering economic injury. You can borrow up to $2 million at 3.75%, which is a very good rate. If you apply for this loan, and this is called a 7B2 loan, you get $10,000 within 3 days. They want to get money to you quickly, and that $10,000 is a full grant. It does not have to be repaid, whereas the rest of the loan would be. To that end, though, as I mentioned, the terms here are intended to be very, very favorable. They're not going to ask for any payments for the first year. They're not going to have required to have personal guarantees up to $200,000. They're not requiring collateral. So there's a lot of normal loan things that are really being relaxed as part of this provision. Something to know, though, is that you can't, as I mentioned earlier, you cannot use the disaster loan to pay the same cost as the payroll protection program. All right, so if you're paying wages from the government money that you got here, you can also use the loan to do that, but you can use it for other things. So, and there are other costs to your business. So that's just a very brief, quick snapshot thumbnail view of the 4 main programs in the CARES Act that you would need to weigh the plus and minuses of and see how it might integrate in with your overall business plan. Let's take a look at some of the key decision considerations as you break this down, things to think about. And these are just some of them. There might be more, but I want to at least give you some of the thoughts we have. One, your composition of your payroll is going to affect whether or not the payroll protection program or the employee retention tax credit is going to be more advantageous. What do I mean by that? If you have mostly smaller payroll, maybe $20,000, $30,000, $40,000 average among your employees, you may actually get a greater dollar benefit by doing employee retention, because that can last more than 2 months than the payroll protection program. Payroll protection is really just money for 2 months payroll. Employee retention can continue out the rest of this year. And so it may actually turn out that 50% of wages over the rest of this year may turn out to be greater than the 2 months worth of payroll under payroll protection. So that's an important thing to know. If you have a larger payroll, maybe 50,000 plus on average, and again, there's a little bit of math there, then it may actually be better to take the payroll protection program, get 2 months worth of paychecks covered by the government, and that would be better even if you are retaining your employees. So one note to know there. Second note, as I sort of alluded to, under the employee retention program, you're continuing to pay the employees. The government is giving you a credit when you file your payroll tax forms. So that means that you're going to need some cash to float that in the meantime. And you're also going to be sharing 50-50 with the government. So if you have some cash on hand, that may be possible to fund that. But from a cash flow standpoint, if there's not a whole lot of cash on hand, you may not be able to sort of take the 50-50 stance with the government, and it may be better to go with the payroll protection program as a result. Another thought to keep in mind. Third thought is employees may find, because of the enhanced unemployment benefits, that they're actually getting a greater pay by being furloughed or being laid off in order to claim that from unemployment. Again, you have to sort of say, how does this integrate with employee morale? How does this integrate with your operations, etc. But it's something to be aware of at the end of the day. If you're using the payroll protection program but your operations, there may not be a whole lot going on, you may start asking yourself, hey, how can I put my team to good use in terms of R&D, building out digital systems that maybe you don't have, developing new products so that when things get back up and running, that you have something to come to market with, you're ready and able to go and hit the ground running, etc. There may be other things as well. So you can consider, even if you have to sit on your hands for 2 months, if the government's giving you 2 months of paychecks, you can say, how can we best put that to use to position ourselves well. So as I mentioned before, there's the employee morale considerations. One, you may want to keep people together, during this time. There's the psychological impact. Having some of that routine may be good for everybody, as opposed to everybody just sort of being separated from each other because of this. And so that's something we also are encouraging the entrepreneurs we work with to think about. what that means just for your company, for team, and sort of what you've built and those connections. Sixth, the economic injury disaster loans can complement the payroll protection or employee retention, which I sort of alluded to in the previous slide. So it's that one's not an either or. That one could set alongside the others if they're needed. But the point to be made there is that the economic injury disaster loans do need to be paid at. And so what we don't want to see, or what we would really caution against, is businesses taking on a lot of debt because you need cash now, and you're going to have to pay that back in a year or two's time, etc. And so if there really isn't a viable business strategy for you right now, it might be better to go into hibernation mode or some other alternate form than it would be to just sort of get a whole bunch of cash and try to carry on as usual, because that loan will eventually have to be paid from future profits. So we're really encouraging folks to consider those skeptically. They may make sense in some cases, in other senses they may not. So don't just take the cash and suffer the consequences later if it doesn't make sense. All right. Those are some decisions, considerations, things to weigh as you think about which path may or may not be the best for you. I'm going to add one other piece of information here at the end, simply because it has a small tie-in. Before the CARES Act was passed, there was the Families First Coronavirus Response Act, and that had to do with emergency paid sick leave and emergency family medical leave. It's not so much a decision that has to be made, it's something to be aware of, that effective April 1, employers under 500 are required to provide paid sick and family medical leave regardless of whatever their previous company policy was. Essentially, it's a 2 weeks worth of coverage for that. The benefit, though, is that the government is essentially going to pay that on your behalf through a payroll tax credit. So you pay the wages, but the government will basically credit it back to you in the payroll taxes. You're required to provide that benefit, make folks aware. You're going to want to properly capture that in your payroll system, etc. But it is essentially funded by the government. And again, there's some math behind how this works, but just I wanted here to point out the big picture on that, because that may end up saving you money if you properly categorize payroll in your system. And as I put here, you can go ahead and read our Insights blog for additional details on that. So, little coda. Let's start bringing it together, though, in terms of next steps. Using this information, some next steps we would recommend you to take. First off, develop your business's coronavirus game plan. Again, don't let the tax tail wag the dog. Don't let these government programs drive what your strategy should be. You want to weave them into your already existing strategy. You can use our video and resources, which I'll link along with this as a help if it is helpful to you. Second, I would get comfortable with the details for you. Sort of look through these different provisions, sort of say, okay, hey, what does that translate into me in terms of dollar and cents in my strategy? Get comfortable with those details. If you're a member of Element CPA, you can reach out to us and have us provide a little counsel and guidance to you as well, so that you can make an informed decision. Then comes the decision. Are you going to take advantage of the payroll protection program? Are you going to take advantage of the employee retention tax credit, or are you going to be looking at unemployment benefits and availing of those enhanced benefits for your employees? After you've made that decision, if you're going to apply for the PPT, I really advise you to act now. It's a first come, first served basis. There is expectation that the money may run out. Congress has indicated they may add additional money, but it's not something to bank on. And the Payroll Protection Program, although it's an SBA program, it's administered through banks. And so really the best thing to do is to contact your banker. Maybe you have a direct rep or loan officer you've already worked with. Reach out to them. Also, the bank's websites, most of them are setting up forms and really trying to make this an online process just because of the large volume of activity. So you want to go to that site, find that page, see if they've already released their form, their application, if they even have one or expect to have one, and then submit it through that route. That's really the best route to go for these types of loans. And then lastly, after you've sort of decided that, you can evaluate, does it make sense to do one of those disaster loans? It's not something you have to work on immediately, but it is something to be aware of and evaluate. So that program is open through the end of the year, but there are some money limits on that one too. So that'd be a next step. So just to sort of close out here, our goal is to sort of provide you with the ability to choose between the relief options in the CARES Act for your business. One of the things I want to maybe provide as an analogy for you is there's a wave that's basically been introduced into the economic operations of our economy. And for some, that wave has been felt very immediately and very acutely. For others, it may be down the road. We don't quite know how long the wave will travel. We don't know what size it will be as it gets to different segments of the economy. But it's important for every business owner to run through an analysis and be proactive. And even if something's already happened to them, to sort of figure out their way through to adapt. So my recommendations: keep your wits about you, look at your business soberly, pull out of the detail. It's very easy to get caught up in all the energy that needs to be in terms of reactions. Take a deep breath and make the decisions and then adapt. Now, hopefully this video has been helpful to you as part of that process. And know that we're pulling with you as well. Till next time, keep building financial strength for what truly matters.